Hey, y'all, and welcome back to The Real Money Talk, where we talk about how money actually works so you can make it work for you. My name is Erica Neal. I am your host, but more specifically, I am an authorized infinite banking practitioner and real estate investor and business owner. And I'm very, very passionate, as you will come to find if you don't know already, about teaching people how money actually works and putting it to work in the most efficient and effective way for you. Now, in this conversation today, we are going to talk about one of the biggest divides in the infinite banking world, talking about the difference between IUL policies and whole life policies. Now, I know there's a ton of videos out there talking about IUL this or whole life that, but being able to understand how each of these work, what they're designed to do, and see a side by side comparison, that's exactly what we're going through for today. So make sure you stay tuned through the entire video to get all of the information that you can. And again, the point of this is to make sure you understand how these things actually work. And so you can decide what makes sense for you. And you guys are going to hear me say this once, twice, 101 times. There's no such thing as a good tool or a bad tool. But there is the option of using the wrong tool for the job. Said another way, is a hammer a good tool or a bad tool? Well, you don't really know, right? Until you go to try to cut a piece of wood in half, the hammer is not going to work that well, right? Like it might get the job done, but it's not going to be efficient. It's not going to be clean. It's not going to be easy. And we can't get mad at the hammer and say, oh, this hammer sucks. No, you're using it wrong. So what we're going to dive into is how do the different characteristics of these policies work? How does it relate to infinite banking? And then that way you can better understand whether it makes sense for you, your given situation, and what you're trying to accomplish. Let's get into it. And remember, if you haven't already, make sure you hit that like and subscribe button so you can help us promote all of these videos and more people can learn about how money works and we can all continually build our financial picture together. All right, as promised, we are going to do a side-by-side comparison of an index universal life, also known as IUL, compared to a whole life policy. A lot of people don't say WL, but I figured why not make it shorter like we did on the IUL side? Now, again, there are a lot of different categories that we're going to discuss today. I have them all listed out here on the side, but I just really want to emphasize a couple of things. Number one, I'm an authorized infinite banking practitioner. And so when I am writing a policy that is specific for infinite banking, being an authorized practitioner means that we only write policies for infinite banking that are whole life policies issued by A-rated, mutually owned, dividend-paying companies. It is very, very specific about the type of policy and company we use because of all of the characteristics and the guarantees built into these types of assets. Now, let me flip to the other side of that. I completely have the ability to write an IUL. I have the license, I have the capacity, I have the companies, I have all of the things to do IUL. And I have written IUL policies when they make sense. When I am writing IUL policies, though, full disclosure, one, we go through a lot of details, disclosures. We really do some risk tolerance checks, and that's going to make more sense as we go through the comparison. So that doesn't mean that I can't write IUL. When I do, there are a couple of T's that I cross and I's that I dot because of my license and my registration as an authorized IBC practitioner. And so we're going to get into that a little bit more in detail, but just know I can write both of these. I have written both of these. This is meant to be a clarifying video to help people understand the difference. I get so many calls on a weekly basis about like, what about this IUL and what is this? What is that? So here we are. We're going to get into real money talk, right? We're going to break down these financial myths and get into the reality of it. So I just wanted to make sure that we are clear on where I stand on both of these, just so you guys are aware as we go through this. Now, the very first thing to talk about, and it's not something that a lot of people are familiar with, is we're going to look at the premiums, okay? So when we're talking about premiums, infinite banking is the concept, it's the strategy of using a specially designed cash value life policy to become your own bank. So instead of keeping your cash inside of a traditional bank or a retirement account, you keep your cash and your savings inside of one of these specially designed cash value policies that as you're building that cash value, as you're building equity within this asset, you can use that cash to go out and do whatever you want. Now, I specifically work with real estate investors, business owners, people who are planning for generational family wealth. And so we are using that cash pretty specifically, but you can use that money however you want. You make the rules. Now, with that being said, yes, you're becoming your own bank. You're creating this alternate, savings type asset. But it's important to remember that we're still using a life insurance policy as the vehicle. This is the chassis upon which the account is created. Now, that comes back to my point on the premiums. Yes, there are premiums that you're paying to own this asset, just like a house, just like a business, just like anything else that has a cost. These policies, there's a premium that's associated with it. Now, we always get into like, well, why would I pay a premium and does that affect the cash value? Again, that's a whole nother video for another day. The point is, we're using a life insurance policy as the vehicle, and there is an associated premium with that. Now, the premiums within an index universal life policy, these are flexible and not guaranteed. So what does that mean? IULs in general are sold on the premise of adjustable and flexibility. Okay. And that's great, right? That fits into what a lot of people are looking for. Now, we have to understand that's a two-way street. You have the ability to pay more or less than your what's called a target premium. Target premium is what you're trying to hit, but you don't have to, right? You can pay more or less. They're not guaranteed, which also means not only can you change the premium, the insurance company can also change the premium. What we've seen happen, and not all companies, but it is not unheard of in the IUL world, that as you get older, specifically after you've had your policy 10, 12 years or so, now you're older. You cost more to insure. Maybe you're less healthy. Maybe the mortality rates and tables have changed actuarially with how the company does their calculations. Maybe the company performance hasn't been what they thought it would be, right? There's a lot of different variables that can go into this. But the point is, the premium and the cost of insurance within your policy can and usually does go up inside that policy every single year. In fact, on the IUL illustrations, there is usually within your policy packet, there's usually a whole couple of pages dedicated to showing how your cost of insurance is increasing every year. Again, that's not good or bad. It just is what it is, and it's something to be aware of. As you get older, these policies can cost you more and they can charge you more because of your age and changes internally. On the other side of that, on the upfront, your flexibility within the premium can change, meaning if you want to pay more or less, right, there's a little bit more adjustability. I don't know if that's a word. Look, I do numbers, I don't do words. So the point is that can change. Now, with a whole life policy, they're guaranteed. This is the only type of policy that once you lock in your premium, once you lock in how much that policy cost is, it's guaranteed to remain level throughout your entire life. Okay, so regardless, if you're 10, 20, 30, 40 years older, if things change internally, this is what's called a unilateral contract. Uni means one. There's only one person that can change the contract once it's in force, and that's you. The best way to think about this is, imagine like your, grandparents or parents, whoever, that bought a house 20 or 30 years ago, right? They bought the house for a super low cost, and their house payment is pennies, right? Like it's now I'm not talking about taxes and insurance. I'm talking about just the mortgage payment of the house. It stays the same. So you could do the same thing with your policy. Once you lock it in, that rate is the same perpetually moving forward, no matter what. Now, here's the polarity between the whole life and the IULs on this is if you are younger and on the short term, there might be, and it's not always the case, but there could be a situation that maybe the IUL premium is a little bit less than the whole life premium. Let me tell you something. There is no such thing as free money. It doesn't happen, right? If it sounds too good to be true, it probably is. So within the IUL, they could potentially be lower in the beginning, or at least they're flexible, so you have the option to pay less. But over time, if those aren't paid, they're going to catch up to you and they're going to be owed eventually. And in addition to that, the cost of insurance is going to be paid for on the back end. So it's just something to think about. Whole life is just flat, stays the same forever. IUL, you have the ability to change it, but it is going to increase over time. So just be aware of that. Now, the next category is death benefit. Again, Infinite banking is talking about the cash value of the policy, but we're still using a life insurance policy as the vehicle. So death benefit is that's part of it. Everyone's a little bit different on this. I have some clients that want a lot. I have some clients that want not a lot, right? So everyone's different, and we do work with everybody on a one-on-one basis to say, okay, if you want more or less death benefit, we can customize that. But at the end of the day, it is still a factor. So how does it work with an IUL policy? Well, again, they're flexible. It's not guaranteed. So what that means is if you pay less on your premium, then you have a lower death benefit, right? Like if you pay less, then that can reduce your death benefit. Uh, Later on, as your cost of insurance is going up, right? Because you're older and you cost more to insure. If it costs more to insure you, but you still pay less than that amount, then that death benefit can be reduced. So it's just something to be aware of. It's not guaranteed and it can, be whittled down because of that flexibility. Again, it's a give and take. If you want that flexibility, the company's going to want that flexibility too. Uh, so again, death benefit, not flexible. It can and will change depending on how you pay. The big thing to remember between the premiums and the death benefit is that IULs have what's called a target premium, meaning they're going to try to hit that target. They're going to try to hit that cost and stay within that realm. Like no company wants to charge you more, right? They know that that doesn't look good, but they are going to try to hit that target. There's no guarantee that that target will be hit on either the premium or the death benefit side. They're going to try to do it, but there's no guarantee. On the whole life side, for both the premiums and on the death benefit, they are guaranteed. The death benefit within a whole life policy, not only is it a guaranteed minimum that no matter what, there's always a minimum amount that's guaranteed to be there, it's also going to increase over time. So we're going to talk about the cash value and all the growth here in just a minute. But the point is, you have your premium and here's your death benefit. As you're paying your premium, that death benefit is going to increase over time because you're building up equity or cash value within the policy. Okay. So whole life, again, it's built on more of a guaranteed. In fact, if you look at the whole life illustration, their premiums show guaranteed. If you look at the IUL, their premiums say target premium. That just kind of displays the difference on what they're actually doing actuarially behind the scenes. And by the way, I'm going to use that term actuarial. Actuaries are, I always call them the nerds in the closet. They're the math people that design these policies. They look at historical mortality tables and rates and all that. They're the ones that design the math and how these policies function between premium and death benefit and cash value. They do all those calculations. So actuarial science is the process and the mathematical use of all of that information to create these types of policies. Okay, moving on to cash value. Within an IUL policy, once again, they're not guaranteed. And the IUL, the index of the index universal life, right, is that it's tied to some sort of market index. The most common one is, of course, the S&P 500. There's no guaranteed rate. Now, some companies do offer a guaranteed interest option within your cash value, where if you want to allocate a portion of your cash value to the guaranteed rate, you can. But IULs in general are going to be tied to some sort of index. Now, with that being said, there are caps and participation rates, meaning there's a floor and a ceiling with which your cash value will fluctuate. So let's say that your floor is, I don't know, let's say 2%. So if the market drops by 10, you are not going to earn any less than 2. So that minimum that you're going to earn is 2, for example. If it drops to 10, the company's going to eat that 8%, right? Or actually, if it drops by 10, anyway, you get it. They're going to eat that loss. Here's the catch. There's no free money, right? If they're absorbing the bottom side, they're going to want to absorb the top. So the cap, so you have your floor, the cap or the ceiling is whatever amount the company puts on there that maxes out how much you can earn when the market goes up. So again, for example, let's say that your cap is 7% or 8%. We'll just use 8%. If your cap is 8% and the market goes up by 10, the company is going to keep that 2% and then give you the 8. Okay, so you function within the floor to ceiling. That is where your cash value can fluctuate. Okay. There's also a participation rate. The option on that is, let's say the participation rate is 50%. You get a 50% participation rate and the market goes up by 10%. If the market goes up by 10 and you have a 50% participation rate, that means you get 50% of what the market did. So if it goes up by 10, you're going to get 5. Again, that's just gonna, now it's still gonna change, right? It's gonna be volatile. It's gonna go up, it's gonna go down. Your cash value is not guaranteed. It can go down, right? Or it can stagnate. So it just has that up and down opportunistic vibe there, right? Between the floor and the ceiling. Now, with a whole life policy, it's just a guaranteed growth plus dividend potential. Now, what does that mean? Well, every company is different. I'm an independent broker, so there's a few different companies that we partner with, right? Different ones for different things. All of the whole life policies have a guarantee. Some companies have a lower guarantee with higher dividends. Some companies have a higher guarantee with lower dividends, right? So they all kind of average out. But the point is, there is a guaranteed rate that they're paying you, and your money is guaranteed to increase every single year, no matter what the market does. It's just that steady Eddie, my business partner, he talks about baseball and Pete Rose, right? He wasn't going to hit home runs. He was going to hit consistent base hits. That's exactly what your whole life policy is. It's not going to get you the 15s and the 20s, but you're not going to lose money either. It's just going to increase on a consistent, regular basis. It's guaranteed to grow every year, completely uncorrelated to the market whatsoever. Now, again, like we said, being your own banker means that you're taking loans against your policy, right? You're borrowing against that cash value. Those loans are going to be on your terms, meaning you decide how you want to pay that back. What does it look like? When, right? At what rate? All of those things. So you, regardless of the policy that you use, have control over the payback schedule. Now, what's happening internally within the policy can vary. Now, with an IUL policy, the loans could potentially reduce the credited interest. Okay. What does that mean? Well, if you have, let's say you have 100,000 and you take out a loan for 70. If you take out a loan for 70 and they reduce your interest, that means you're only earning interest on the $30,000 left over. Now, if you have a non-recognized loan, meaning you take out the loan and they don't recognize it, what that means is if you have $100,000 in cash and you take out a $70,000 loan, you still earn interest at the full 100,000. So IULs, it could potentially reduce, right? There's different options there, but they can carry variable terms depending on the market performance, right? So all of those, the rates and everything that are attached to the policy are going to be dependent on market performance. Now, IULs do have a non-recognized option, meaning if you take out the 70, you're still earning interest on the full 100. That is an option, but it's just something to be aware of as far as the interest rate, which we're going to talk about. When you borrow against your policy, you're paying back that loan at a given interest rate. That interest rate is set by the insurance company. Those rates can vary, right? Again, that's depending on market performance, that's depending on company, and everything in between. Now, it's pretty much the same with a whole life policy. You can do, not all companies, the ones that I like to use, have a guaranteed rate or a variable rate where you get to pick and choose. Do you want the guaranteed rate for the loan or do you want the variable option? You get to choose between that. Now, for infinite banking, we are usually going to use what's called the non-recognized, where if you have 100, you take out 70, you're getting still credited on a full 100,000 because we're going to be able to take that money, go invest it elsewhere, and you're going to earn more than what you're paying in interest by investing it outside of the policy and allowing the 100,000 to compound and grow on this guaranteed growth plus dividends. So again, we'll get into that in a little bit more detail, but the point is the loans, they're going to be pretty similar between both. Most of them are going to have options. The IUL is typically going to be more variable and related to market performance. Now, let's look at dividend eligibility. So a dividend is when you have a company that has profits on the books and they say, hey, we want to return these profits. We want the owners of the company to participate in this. Now, if you're a publicly traded company with stocks, the stockholders get the dividend, right? If you're a mutually owned company, that means you don't have stockholders. That means that you, as a policy holder, are part owner of the company and you can receive dividends. With an IUL, there is no there is no dividend eligibility. Your cash value and the earnings that you're getting on that cash value are related to your index, right? Whatever you're invested in and your floor and your ceiling. That is the only growth that is credited to the account. With a whole life policy, like I mentioned, as an IBC authorized practitioner, we only use whole life policies that are issued by A-rated, mutually owned dividend paying companies. So, yes, you are eligible if it's from a mutual company. Again, those are the only ones that I use for the whole life. Now, here's the thing, dividends are not guaranteed. Like legally, we cannot say that the company is going to be profitable. Now, when they are, they redistribute those profits to the owners of the company in the form of a dividend. As a whole life policy owner, you are a quote unquote part owner, a mutual owner of the company, which is why you're entitled to a dividend. Now, again, they are not guaranteed. However, they are incredibly historical reliable. The companies that we use are all over 100 and 120 years old, right? They've been around for a really long time. And every single year since their inception, they have paid a dividend. So, no, they are not guaranteed. We cannot legally say that. However, they have been paid for over 100 years straight. Take that however you want, okay? That's completely up to you. Now, let's get into the arbitrage. So, what happens here is just like the banks, when you go to a bank, you make a deposit with the bank and they pay you very little, right? They pay you like 0.2%, if even that. They're going to take your deposit and then loan it out to somebody else at 7, 8, 9%, right? So they're charging 7, 8, and 9, and they're only paying 0.2, and they're keeping that spread. That is called arbitrage. That is how banks make money. I have a whole video over that. It's a how do banks make money? You can recreate that same system. Becoming your own bank means that you're doing that same system within your policy. So if you, again, have 100 and you take out 70, you take out that 70 to go out and invest. Now you're paying interest on that policy loan, like we just talked about. There's interest on the policy loan. But you're creating arbitrage because you are earning more in interest than what you're paying because you are not only investing that money outside, you're also still earning compound interest and dividends on the full 100,000. So you're earning compounded while paying down the interest on the 70. So what does that mean as it relates to an IUL policy? Well, here's the thing. Arbitrage within an IUL policy does have the potential to be negative, meaning you lose money in that transaction because there is that opportunity for a lower stock market performance. What do I mean by that? Well, let's say again, like I said before, the market goes down to goes down by 10%. And your floor is let's say 2. So if you're only earning 2, and I've seen of them that have 0, right? But let's say you're just earning 2. And if you're only earning 2%, but you've borrowed against your cash value and you're paying, let's say, 5% on that, that's a negative arbitrage where you are paying more in interest than what you're actually earning. IULs do have that risk because the cash value is volatile and it's tied to market performance. Now, on the whole life side, your growth is guaranteed. It's always, always, always going to increase because you have the guarantee. You also have incredibly reliable dividends. In fact, the dividends do get bigger and bigger and bigger every year because you have more and more, you have a bigger and bigger policy as you're paying into it, which means you have more and more ownership of the company. So the point is your dividends get bigger and bigger and you have a guaranteed rate that's being paid. Because the growth within the policy is positive, then that gives you the ability to actually earn arbitrage. So even if the market tanks, your rate is staying the same. And so that's why you're able to create arbitrage more consistently within a whole life policy because you have a guaranteed rate that's always going up and you're paying down on your policy loan. Now, what's the risk profile here? At the end of the day, if we were to profile these two different types of policies, well, as you can probably guess by now, IULs, it's just a higher risk tolerance. That's the bottom line. There's volatility within your cash value. It's going to go up, it's going to go down, it's going to be right up and down all over because there is reliance on the market. Let's be honest, like we have no idea what the market's going to do, right? At this point, we just know that we don't know. It's been crazy. Now, there's definitely the opportunity that it could be great. We could earn a lot, right? Like there's a lot of good things that could happen. But we also have to understand the risk that it could go down. And as long as we understand that risk and that we're willing to manage and work with that and navigate that, then okay, you've got to be aware of that. In fact, I have a waiver that I require people to sign that says they understand the risk of their cash value fluctuating. They understand the risk that their premium is not guaranteed. They understand the risk that their death benefit's not guaranteed, right? Like we just need to acknowledge the risk. As long as we understand that, we navigate it appropriately, then no harm, no foul. So again, it's just something to be aware of. Now, obviously on the whole life side, it's a lower risk exposure, right? Like it is, that is why whole life is what is pure infinite banking because it's guaranteed. There's guarantees, there's insulation, right? There's no market volatility. And so it's one of those things, I'll be very clear with you guys. I have whole life policies on myself and my family. That's what I want to use. Now, don't get me wrong. I take risk in a lot of other places. I'm in the process of buying a business. I have stock market. I have crypto. I have real estate, right? And so trust me, all of those things have a lot of risk. My personal profile, my personal financial situation, my money inside of my policy is not, my infinite banking policy is not an investment. It is my bank. And my personal opinion is I don't want to wake up in the morning and wonder, oh, I wonder how much is in my bank, right? Or, oh, did I lose money today because the market went down? Listen, I personally have enough risk and I have enough to deal with on the investment side in my actual investments. If you, this is infinite banking, it's not infinite investing. If you're putting money inside of a life insurance policy to get the best rate of return, again, that's like trying to cut a piece of wood in half with a hammer. That's not what these are designed for. There's a lot of tax benefits, there's asset protection, right? There's this arbitrage. All of those things are good. These are not investments, they're just not. So for me personally, I choose to keep my cash and my liquidity safe and protected because my money that's outside of the policy is working, it's growing, it's exposed to risk, right? There's plenty of wealth eroding factors out there. This is the part of my financial picture that I've decided to keep protected. Now, I have clients that are like, nope, I want my money, high risk. I want to do that. Again, go on with your bad self. You can do whatever you want. I'm just telling you, like, the reason that I don't is because I don't want one more thing to deal with. I just don't. Which that comes back to policy management. IULs are going to require active monitoring to ensure proper crediting and avoid policy lapse. So what that means is there's the point to point, you can do participation rates, you can do the floors and the ceilings, and oh, well, do you want to measure this or do you want to measure month to month? There's a lot of different maneuvering factors to the growth within an IUL policy. When you have an IUL, there is a much higher policy management requirement. That's not a good thing or a bad thing. It's just something to be aware of. If you have an IUL, you're going to have to do active monitoring, especially at least on an annual basis. And you say, okay, am I going to want to change to participation rate? Do I want to be on the cap? Do I want to have right point to point? Again, you have to maneuver and change all those things at least on an annual basis to make sure that the crediting is proper and that you're actually getting interest earned and that you're not losing money because of market volatility. Now, to avoid policy lapse, this is another area that we have to be very serious about because all of this is meant for long term, right? This is long term generational wealth. You don't just, I'm sure you were like me, you got a job when you were 15 or 16, open your bank account and you started saving. No one's like, oh yeah, I'm only going to have this bank account for like 2 years. No, we're usually using this throughout our life, right? We're saving money into it and we're allowing our money to grow as we invest in these deals outside. In order to avoid a policy lapse with the policy just not being sustainable anymore, and it can just, again, it can lapse and cancel on itself. If your premiums start to get too high, if you're not funding it enough, right, the death benefit can wither down to zero and the cash value is gone because it's gone down because your cost has gone up, the policy can lapse. So it's important to make sure that you are funding enough into these policies so that they don't lapse. And that is for both the premium and the loans. So when you take out a loan, you can decide how, when, and if you pay those loans back. But if you don't pay those loans back, it can cause your policy to lapse. If you don't pay enough of your premium, it can cause your policy to lapse, right? So again, Not good or bad. It's just something to be aware of. It is a commitment that you are going to need to manage that policy much more actively. Versus on the whole life side, it's a little bit more of a set it and forget it style. So this is money you put it in the policy. You're going to pay whatever you need or want to pay, right? So within the whole life, there's a minimum, there's a maximum, and you can fund anywhere in between, right? Again, there is a minimum. You decide what that minimum is. It's up to you, but you can pay your minimum up to your maximum, and you can go anywhere in between every year. So there's still a lot of flexibility, but you're just funding that on, again, whatever basis you feel makes sense. Now, as you're paying it, you could, take that money out and go invest, or you could just let it consistently grow and compound. So it's much more set it and forget it. Again, this is a big thing for me. Listen, I'm running the business. I'm buying another business. I'm managing real estate. I've got kids. I've got a life. I've got a lot going on. This is for me personally why I chose to do a whole life policy, because I've got enough going on. I don't need one more thing to manage. I want my cash and my liquidity to be there and just consistently grow, right? There might be years where maybe I get 6 and the market did, 8 or 10. But there's years that, maybe I get 6 and the market did -10, right? I don't have to worry about it. It's just to set it and forget it. Again, we're not getting like 15 and 20%. We're just getting those consistent base hits, like David says, that Pete Rose of baseball, just consistent growth, slow and steady, right? Now, before we get to the last category, if you haven't already, hit that subscribe button, like, share, let other people know. The more that you do that and the more you support us, the more people we can impact and the more knowledge and wisdom we can share. Now, who's the ideal user? Again, no good or bad tool. I'm not saying yay or nay. I just wanted everybody to have the information that they need to make a fully informed decision. The ideal user for an IUL policy is an investor, somebody who is seeking high risk, high reward. There is flexibility, but you're willing to manage more complexity. So, and when I say investor, I'm specifically referring to people who are investing in like the stock market. A lot of my real estate clients, they don't want to do an IUL. And here's why. The market goes up, the market goes down. People are buying real estate. I have a lot of multifamily syndicators, self-storage, single family, right? Whatever it might be. The point is, when does most buying opportunity in the marketplace tend to present itself? When the market's up or down? When the market's down, right? That's usually the time to go buy. But if the market's crashing and that's when you want to go buy, well, if your liquidity is tied to the market, guess what? That means that your liquidity is lower too. You have less liquidity because it went down with the market. That's why a lot of my real estate people don't want to do an IUL. Again, that doesn't mean that it's bad, but it's because their buying opportunity, the environment that's going to be the most fruitful is when the stock market is down. So they want to make sure that it's always increasing. So when I say investors, I'm specifically talking about actual like stock market investors that are going to be dealing with that complexity and all of those types of things. So it's just something to kind of be aware of. I have also used IULs for like a buy-sell agreement. So this is very, very popular for IULs, specifically because a lot of these buy-sell agreements are only in place for 10, 15, maybe 20 years, right? Depending on the owners of the company and longevity, things like that. But the buy-sell agreements, the cash is available to be used by the business, but it's mostly to, one, have a buyout at the end of that, 5, 10, 20-year stretch. And it's also to act as key man, where if one of the owners of the company dies, there's a death benefit that pays out. So my point to that is, these business owners, they want a buy-sell agreement for the future use of the cash. They also want that death benefit protection, but they don't want or need to use the money on a regular basis, money going in and out. That is a very high possibility that an IUL could make sense, and I've done it for those types of situations. So, a couple of ideas on ideal user. Now, who is the ideal user for a whole life? I feel like I've already kind of told you guys, but these are long-term investors. These are people who are building long-term wealth, right? They're focused on their cash having predictability. They want asset protection, and they're focused on building generational wealth. Okay. Now, again, that one versus the other, I've kind of shared with you guys my personal investment philosophy. I'm focused on the long term. I don't want to get rich quick scheme. I'm not trying to get the best rate of return, right? Like, yes, rate of return is important and investments are important, But that's kind of like offense, right? Like I understand putting points on the board is important. Now that I've gotten older, right? Like I'm a cranky old lady now and I've had some life experience, I realize that defense is just as, if not more important than offense. And so defense is protecting your cash, right? From market, from, creditors, from lawsuits, from, you know, uh, market crashes, from volatility, from taxes, all of these wealth eroding factors that are out there. My money inside of my whole life IBC policy is shielded and protected and unaffected by those threats. Now, I still have all these outside assets and things that I'm building and growing, and right, like those are my investments. That's my saw, right? My whole life policy is my hammer. Two tools designed for two different jobs, right? So again, you can use the hammer and saw analogy. You can use the offense and defense analogy, right? I'm from Texas, so we love our football. But that's my point. It's going to outperform inflation. It's going to outperform your bank account, right? Money markets, things like that. But it's not meant to be this high growth investment. So again, if you're a long-term investor that's focused on like you want predictability with your cash, you want to have asset protection, you want to be able to go invest in other assets that do carry risk, then the whole life might make sense. If you're a little bit more on the short-term side, you're looking for higher returns, a lot of flexibility, but you're willing to compensate with managing more complexity, then the IUL might make a little bit more sense. So again, I hope this helps in breaking down the difference between these and really looking at a side-by-side comparison. And that's pretty much it. Of course, there's so many other nuances and actuarial differences and cash. And again, we could spend hours going through the differences on these types of policies, but I wanted to make sure to give you just a simple, quick, easy breakdown, side-by-side comparison so that you can understand the differences in those and why do some people say one is better than the other. Let me tell you right now, one's not better than the other. Again, it's like a hammer and a saw. You need to understand and decide what are you trying to accomplish and then use the right tool that fits that job. Otherwise, it's not going to work out well. Now, don't forget, if you have questions or want to see what a policy looks like for you, we're here. So me and my team, we work with people, primarily real estate investors, business owners, people who are building generational wealth. But if you're wanting to learn and understand, and you're even in the beginnings of your wealth building journey, we're here for you. We're here to teach, we're here to educate, and we're here to provide custom, tailored policy designs that are going to fit you and fit you in a way that you can start at a comfortable level and grow over time. We would love to meet with you one-on-one. And until next time, guys, keep it real.